you adjusted to the new rates of change in foreign exchange and bonds and the real interest rate? How have you adjusted in the last 10 days?
Well, you're either in a defensive position or you're looking at a lot of immediate pain in portfolios that you can't turn the clock back on. We have been adding U.S. Treasuries, not because the yield is some incredibly high, beautiful, inflation-adjusted level, but it's a defensive asset that's probably going to work for a period when the economy turns. And unfortunately, we are heading for a turning point in the American economy, and I think we'll do that quite well below the rates that the Fed is signaling for 2023.
90 days ago, we were angsting about corporate earnings, and I think they did better than good. Someone out there has October 14 as a launch date here. We're a little bit of ways from there, but let's go to your expertise there. Are we going to be shocked again at a resilient corporate America?
Well, we probably shouldn't be. The look back at the third quarter is still going to be a period of rising production, rising inventories. That's a problem for next year's profits, not for this year's profits. What's happened in financial markets and financial profits is telling us where we are headed for the coming year. We would expect about a 10% decline in U.S. EPS next year, again, at a level well short of the Fed funds rate that they are guiding us to, again, to try to maximize the impact, to sort of pull all hope away from the notion that they might pivot. But if you take a look at what the Fed is forecasting, the unemployment rate to be about a half point within this range for the next 3 years, we think it's very unlikely. We think that the U.S. is headed closer to 2 million job losses net over the course of next year. And that's, again, if the Federal Reserve will ultimately not continue to tighten through those job losses. But we wouldn't expect them this year, right? The lags between where the economy, again, started to absorb these rate hikes and where it is right now, it's not going to be immediate. We would expect non-farm payrolls to grow through the rest of the year. And just one really simple example. If you think about what's happened to the monthly pace of new home sales, it's down 51%. But home completions, spending, construction spending, or even employment in residential construction, it's down 2% in a new cycle high for employment. That's because we were building houses and starting these projects a year ago at a lower interest rate level and a higher sales pace. So these are the types of things that have to work through the economy. But forward-looking financial markets should be focused on next year.
Stephen, where are we heading in terms of the new normal? Are we heading toward a rebound, the likes of which we haven't seen in 2009 at some point, if the Fed does shift gears or if there is some sort of washout event? Or are we heading toward a lost decade of profits where you get basically leadership meandering from one area to another and not from big tech?
What I would imagine is that we can have a cyclical recovery in 2024. Right. Unfortunately, we've simply run a pro-cyclical monetary policy with the help of fiscal policymakers turning COVID into a boom, right? Not having targeted, limited stimulus, giving a boom and then taking it away and driving a bust. These are not the things that sort of drive economic growth for a 10-year period of time. Again, it's some really rough elbows here from policy. But it's not going to, again, stop innovation. It's not going to stop any of the things that drive economic growth in the long run. Just take a look at 2002. That was a period in which the NASDAQ fell 78%. But some of the key innovations that drove growth over the coming 20 years were literally invented at that time. Apple's iPod, iOS, these are just examples of things that move the trillion-dollar economic gains for years and years to come.
And I'm sure that Tom will pick up on this, and he's been talking a lot about this adapting, the adjusting, the innovation. On the flip side, there's also the social aspect overlaid on top of this, especially as inflation starts to bite into the lower and middle income Americans and globally. And we're seeing that in elections. We're seeing that in a lot of the strikes and the uprisings. How do you price in political risk at a time when it's really coming to the forefront?
Well, it's not terribly easy. And usually these types of political risks, in 9 out of 10 cases in the last 80 years, have not been turning points for the world economy. They matter a lot in terms of driving local, regional crises, but they don't really turn around the world economy. Now, unfortunately, there is a lot of bad news to absorb here, and markets could have seen more of this coming, perhaps. They may overreact to this, but ultimately curing inflation at what we expect will end up being, unfortunately, a good deal of cyclical economic pain. Right? It's going to come at the expense of the labor market, but we're not going to have long-term inflation instability. Right? That's what I think one of the messages that we're going to see. So we're going to end up interest rates peaking at a relatively low level. And unfortunately, we had to go through a boom and bust cycle. But whether you can feed that back to a particular political outcome that's going to change the economy, all we can do, again, is have some safe assets in our portfolios in that event.
But then looking at the Citigroup platform, and you guys have been phenomenal with Hollenhorst on the Fed call and all that. Stephen Wieting, when does the United States not ignore what's going on internationally? When is the point where it becomes like what you and I studied in the 90s, where, I'm sorry, international matters?
It could take some time. Unfortunately, the Federal Reserve is focused very much on lagging economic indicators. In fact, domestic services price, core services, again, have got a power to them. They are a component of the index of lagging economic indicators. And if you just focused on, 2%, we need that 2%, well, we could be deep into a recession before we see 2% on these measures again. And so these effects from around the world, we think, will compound against some of the downward pressure on the economy, downward pressure on prices. We don't expect every CPI reading to look like August on the core going forward. But it's going to be a while before you really see that in the economy. So patience, something that central banks told us to have for a while, they've run out of it. And it would be a good time for us to realize that again. The one thing that we heard out of Chairman Powell, I think was really it was a minor point at Jackson Hole, was that it's going to take some time to get inflation lower. And if they try to achieve it very, very quickly, we're going to end up with a much worse cyclical trade-off, more than is necessary.